Good morning and welcome to another edition of the Main Management Market Note for the week ended May 8th, 2026. We are getting into our offerings here. We've got a new look this week for the deck overall. Maybe you noticed, maybe you didn't, but in any case, this is what it is now. On the performance side, more up than down. Definitely, this kind of been the trend over the last couple of weeks since the bottom, which makes sense because we're going higher. But year to date, the broad indexes only fixed income is negative. That's kind of on bond yields pushing back up. And then on the sector price performance, you've got comm services, financials, and healthcare are the only three sectors in the red. Healthcare and financials down 6 and 7 respectively, while energy and tech are up over 20%. Tech has really made a bid in the last couple of weeks. I think it was like 8% last week or something.
8%. And then the Mag 7, I think that's one thing that's you've seen is that spread between the Mag 7 and the 493 has started to spread back out a little bit. That it came in during the drawdown, and then obviously you've had semiconductors and kind of these mega caps start to lead again, which is been interesting to watch.
Yeah, and then on the international side as well, you're seeing some catch up. Nasdaq was above the ACWX, up 5.5 versus 2.5, and then it's also above the All Country World on a year to date basis, up 16 versus the ACWX up 10, but the S&P still lags that ACWX up 8. So you're seeing more up and down, which is a good thing for our retirement accounts. On the recession dashboard, not a ton changed here. Over the last week or so, kind of data was, in line with expectations for the most part. We did get a surprise to the upside on non-farm payrolls, which were up a solid 115,000, roughly double forecasts for a 55,000 reading. That 6-month average, that kind of dotted line there, you see it hooking up. It's now up to nearly 55,000. That's the highest since May of 2025. So you're seeing some good acceleration in the labor market. That kind of, that February reading was a bit of a concern, but you saw some kind of volatility in those two January, February readings when you got seasonality and weather and stuff. So that's kind of, behind us and looking forward to two solid readings in a row with that upward revision to 185 from 178 in March. And year to date, we're up 300,000 jobs year to date. That's good.
Yeah.
Under the covers, there's some kind of worries, as always. But I think, that 115K was good for the headlines. The unemployment rate was unchanged at 4.3, while the broader U6 rate ticked up to 8.2. Labor force is down by 92,000. Participation rate was down to 61.8. And the number of unemployed persons rose by 134,000. You also got those not in the labor force up 188,000. So some kind of, I guess it seems like it's kind of more moderation. There's also important to remember that participation rate, it is 16 and up. So it includes everybody. There's no age cap. So as people retire, they are still in the participation rate calculation. And really, if you look at the 25 to 54 kind of prime working age cohort rate, that's near multi-decade highs. Up above 80%, almost 80, I think it's 83.8%.
Yep.
And you're seeing the 55 plus and 65 plus, especially, those participation rates are dragging as baby boomers are retiring. So it's important to look at the kind of prime working age is more indicative of what's going on relative to those kind of in the retirement cohort, which are falling out and dragging that overall participation rate down with it. We got wages accelerated to 3.57% year over year. So that's nice, especially when you've got inflation coming up on the back of the oil prices here. But overall, pretty solid jobs report.
Yeah. One thing I'll say is kind of the pattern that you've seen the past almost a year is you've had one strong month and then one negative month, one strong month and then a negative month.
Yeah.
You've finally broken that pattern and had 2 consecutive pretty strong months in terms of job gains.
Yeah.
If you look under the covers, it's not as strong as maybe the headline suggests, but it's still overall better than it was maybe at the start of the year or 9 months ago.
Yeah, and it certainly has made the Fed's decision process easier as far as they can now focus on inflation, which is rising, while the labor market is kind of chugging along here. So that's a nice development as well. People were afraid a little bit after that February reading that you were going to get another bad month, and we just have gone the other way.
Yep.
On the productivity side for Q1. It was up 2.9% year over year, which is the biggest year over year increase since Q3 of 2024. The quarter over quarter annualized figure was up at Q over Q was up 0.8. That's the slowest in 4 quarters and below forecast for a 1.4% increase. So again, it kind of depends on where you slice this. If you look Q over Q year over year, but longer term, you've seen these year over year figures have just been solid for the last 2-3 years. And I think, as far as we're concerned, we remain in this kind of broader, longer term productivity upswing that began basically back in
Yeah.
2015. But this AI kind of, kicker should give it some more legs to move up. We kind of view this to continue to accelerate, in the coming quarters. On the right, we show unit labor costs. Those slowed to 1.2% year over year. That's the smallest since Q3 of 2023. And that was also nice on the inflation side because you're getting a lot of kind of bad headline
Hmm.
readings on energy and oil prices. And that's driving inflation higher in other measures. So to see kind of those unit labor costs on the personnel
Hmm.
employment side is a good deceleration. On the job cut announcements, this is kind of challenger grade job cut announcements. And again, these are announcements, not reality.
Hmm.
So not not all of these come to fruition. But the announcements rose to 83,387. That was up basically 40% month over month, but down 21% year over year. So, you've got this continued dynamic, which started last year where we had the first full year where we had more cuts than hires announced. And that's continuing this year where cuts are outpacing hires. And that's just kind of
Yeah.
the way it's gone. I think people have kind of looked at this as an area for concern. Year to date, we've seen over 300,000 cuts announced. So that basically nets out all of the non-farm payrolls.
Hmm.
But again, these are announcements, not necessarily fruition. And then, just basically 61,000 hires announced. That delta of 240K is pretty sizable. On the right, we got kind of reasons for cuts, market conditions, and closing. To me, it kind of confuses me on those two because if market conditions are bad, that
Yeah.
leads to closing.
Yeah.
So, but those are the cuts reasons. Those are the two biggest reasons for announcements. But then you've got AI here in third. That's really come up strong. It's been cited for 36,831 cuts over the last 2 months versus market conditions at, half that at 14,500 and
Hmm.
closing at 28.7. So you've definitely seen an acceleration in AI here. Again, these are announcements. Remember back when Salesforce and the SaaS
Hmm.
apocalypse was taken off a cliff when they were like, "Oh, AI is going to eat Salesforce," and you're like, "I don't think that company's going to
Yeah.
zero." So this is, maybe some continuation of that. But I think it's just worth noting directionally, AI is definitely cropping
Yeah.
up more in the news.
It's also like perception wise, people will announce, companies will announce cuts and cite different reasons. And it's all about kind of framing to the public, to employees, to
Yeah,
investors, like, why are you cutting jobs? And I think AI has obviously been in the topic of conversation.
yeah,
It's kind of a cool thing or like sexy thing to quote,
yeah,
to say like, oh yeah, we're getting all this efficiency with
yeah,
AI. Whether or not that's happening right now is kind of TBD. You're starting to maybe see it in the productivity. I think
yeah.
I'd say it's too early to tell. But not doesn't necessarily mean that's actually why they're cutting.
Yeah, it's very true. And on the industries, only 5 industries have more hires than cuts year to date. That's aerospace and defense, entertainment and leisure, automotive, utility, and energy. So the vast majority of industries have
Yep.
announced more cuts than hires. Again, something to keep an eye on. We also got JOLTS. This is again always delayed, basically a month behind non-farm payrolls, but this showed just kind of continuing moderation. Not a ton changed here. Openings on the left, black there, ticked down to 6.87, above forecast for 6.84 mil. Hires on the right jumped to 5.55 million. That's the most since Feb of 24. And then month over month, those hires were up 655,000. This is the biggest monthly increase since May of 2020,
Hmm.
when we were reversing kind of the COVID cuts in March and April of that year. Quits on the right in blue ticked up to 3.17, while layoffs moved back up to 1.87. That's the biggest monthly gain since June of 2025. But again, things are kind of trending steadily sideways to a little bit up here. And it's, again, kind of confirmation. We've already lived through March is 2 months ago now, but basically labor market's on solid footing, and it's good
Hmm.
to see hires increase. And quits are also indicative of, confidence or worker confidence in the ability to find another job. So maybe we're starting to put a bottom in there because people have been quitting left and right for a while,
Hmm.
for a while there. And then finally, on the sentiment side, somehow this Michigan Consumer Sentiment Index just keeps going lower.
Yep.
So it hit another all-time low of 48.2, well below forecast for 49.5. This is the prelim, so flash could be, or final reading could be revised higher.
Hmm.
Again, with the intra-month readings, I think last month, the preliminary reading was like the week before the ceasefire was
Yep.
announced. So the revision was markedly higher as
Yep.
people were like, oh, it's open now.
Yeah.
But now we've had a month of open, close. And I think higher gas prices, people are definitely pretty pissed about that. The current economic conditions index hit another all-time low at 47.8, while expectations actually ticked up a bit to 48.5. So maybe people are kind of looking through and hoping that these gas prices will abate a little bit in the next month or two. California, I think the headlines are saying we've got like 6 weeks of gas left, and then things are going to go a little haywire, more haywire than they are here. So we can't wait for that to happen because we're doing really well on that front. And then, speaking of the higher prices, 1 year inflation expectations came back in, so down to 4.5, and 5 year down to 3.4. So you are seeing people kind of give back a little bit of those kind of very pessimistic spikes on the inflation expectations. But I think the point here is people are kind of starting to maybe look through the immediate present situation.
I know we've talked about this before and probably sound like a broken record to some extent, but this consumer sentiment in general is kind of an inverse indicator with actual forward equity returns, stock market returns. If you look back at any sort of time when the sentiment has reached a low or kind of a cycle low, and you look out, okay, what did the market do over the next 12 months? Generally, it's pretty positive. Obviously, past performance doesn't, all that, but the signal or the kind of trend is there historically, where usually it's kind of a good environment looking forward. You look past all of the negative sentiment. Just as a point to that, the market's at an all-time high. Like the market clearly does not feel the same level of pessimism that consumers are feeling, according to this.
Market's looking at record profits, record earnings, and consumers are looking at near record gas prices. Those are two very different lenses to view the economy. So it makes sense that the consumer is a little bit less happy. So in summary, non-farm payrolls up another solid 115K, March revised up. A little bit of, softness under the covers, but again, this along with the jolts and kind of the job cuts were kind of, I don't want to say they're noise, but more noise than signal in this case, when you just kind of got things trending sideways, chugging along as they are. Productivity up 2.9 year over year. That's the biggest since Q3 of 24, and unit labor costs slowed, which is a good development for inflation. And then, sentiment remains low. People are feeling the effects of gas prices. They don't like those checked bag fees being increased, as airlines have seen, double in jet fuel costs. So hopefully that kind of starts to come back down a little bit here. But for the time being, people are not feeling great, and it makes sense. We'll leave it on that very happy note. Thanks for joining us, and we'll talk to you next time.
Thank you.